Hello and welcome to this second program in the series, the Carbonless Asia Leadership Series. Now, these three programs are all about getting to grips with Asia's carbon challenge, and a massive challenge it is. This region produces more than 50% of the global carbon output and consumes more than 80% of global coal production. And despite much apparent progress in the general awareness about UN Sustainable Development Goals, the reality is that things are actually getting worse, especially here in Asia. The region's banks are still continuing to heavily fund polluting industries. Banks in Japan, India, and China alone underwrite the financing of some 70% of the world's coal production. Institutional investors are also still very much a problem. The US investment industry accounts for about 58% of investment into this area, with Japan and the UK following up behind. So how does all this square with all the talk we hear about net zero? After all, there are now 127 countries, most of the ones I just named are among them, who have pledged to eliminate their carbon emissions within the next 30 years or so. And there are companies across the world who are lining up to make similar commitments. But does any of it have any chance of succeeding if the financial world keeps providing money to those who would use it to pollute? So what can we do to change the calculations, to rebalance the books so that finance doesn't keep finding its way to the wrong places? Today I have with me three panelists with considerable experience and expertise in the world of finance as it relates to these questions. Allow me to introduce them to you. They are, in Switzerland, James Gifford, Head of Impact Advisory at Credit Suisse. In Singapore, Nikki Kemp is a Director of Sustainable Development Investment Partnership at the World Economic Forum. And in Bangkok, Paul Ark is an advisor on ESG and sustainability at Gobi Partners, one of the longest standing venture capital firms with over $1.1 billion in asset under management. Panel, thank you very much indeed for joining me for this conversation. It's great to see you all.
Thank you.
Thank you for having us.
James, let me start with you. I mean, I laid out a couple of really sketchy facts there, sketchy in the sense that they're very, very superficial, not too detailed. So just frame for me, if you would, what the challenge is in front of us and how you think we should frame the question facing the financial industry.
Yeah, thanks, Taimur. So we have a huge challenge ahead of us to get to net zero by 2050. And there are three key drivers as we see them. The first is regulatory change, which is going very strongly, particularly now in the United States with the new administration. But Europe and other countries are really taking, Europe and other regions are really taking this very seriously. So that's a huge driver. Consumer preferences are also a big driver, particularly in Western countries, where consumers and also NGOs and civil society are really pushing this. But actually, one of the biggest drivers of the climate transition will be technology. And just like the Stone Age didn't end because we ran out of stones, the fossil fuel age won't end because we run out of fossil fuels. We will simply find cheaper and better ways to do that. So that is really a lot of what we've been focusing on, is the technology and funding those new technologies that we believe, within a decade or two can actually simply be cheaper than fossil fuels.
But as I said, we're still continuing to fund the old technologies at a rate that is not in any way compatible with the SDGs.
Yeah, and I think this is what climate risk and carbon risk and stranded assets is really focused on. So the concept of stranded assets is that there are a lot of fossil fuels in the ground now which can never be burnt based on any realistic climate change scenario, and these are going to have to be revalued downwards, and this is going to be very damaging for a lot of industries. So I think a lot of the finance sector needs to recognize that there are huge risks involved in the decarbonization of the economy, and they need to transition their lending books and their portfolios sooner rather than later.
Paul, you're a finance professional. Your not your loan portfolio, your investment portfolio presumably includes a lot of companies that could do a better job as far as reducing their carbon emissions are concerned. What does this challenge look like through your lens as you look to invest money for return?
No, that's a very good question. Of particular, what is a particular challenge is within the finance realm. I occupy the really early stage venture space, the venture capital space, which as an industry tends to actually be fairly risk averse. As strange as that might sound, working in early stage technology, in the sense that most VCs do tend to follow trends. So I think for the greater part of the previous decade, the venture capital space probably didn't give enough attention to the types of technologies that were environmentally conscious, that would drive economies and markets to net zero, simply because there wasn't any interest in it. That's not where the momentum was from a venture capital funding space would have been. But I think what we're seeing now over the past few years is a greater awareness of a lot of issues that are surrounding sustainability and climate. I think one of the things that I tend to mention is that the world has been seeing so many of these so-called black swan events, from a climate perspective, from a race perspective, from an economic development perspective, droughts, wildfires, civil unrest. It's gotten to the point where, when you have these events happen so frequently, can you really call them black swan events?
It's
the
interesting,
implication
isn't it,
being.
You talk about this, and you talk about momentum, and you talk about how the trends are going. And certainly from a media perspective, having been a media professional for a number of years, I know exactly what you mean. We as media professionals tend to jump on the latest trend. But also I know from having been in the media that when we do that, we give a very distorted picture as to what the reality is. So just because we're spending an awful lot of time now covering things that we didn't used to cover, doesn't necessarily mean that the underlying reality has changed. And again, as the question I put to James, although we think that there has been a change in trend, when you look at the underlying numbers, you still tend to see a lot of money going into all the wrong places. And so as a finance investor, how much difference is the trend that you're talking about making to your actual activity, to your bottom line?
Well, and I'm glad you brought that up, simply because I think the role of any good financier, and particularly those of us in the VC space, is being able to not just keep an eye on what's in trend at the given moment or in the given year, but also sort of, telescope out and see, what are the longer term trends in technology and funding. And so I think there is a growing recognition that there have been a number of these once in a century type of climate events, social events that are driving a lot of attention, particularly amongst millennials, towards issues that are going to greatly impact their generation. A lot of it being climate focused, and so investors are starting to take notice.
Nikki,
just to
go ahead, Jim.
Sort of challenge the idea that nothing's happening or it's not happening fast enough. I think if you just look at the flows into both renewable energy and also into ESG and sustainable investing, it is just staggering. And ESG investment, sustainable investing.
What is it as a percentage?
Well, I think the signatories to the UN principles for responsible investment are well over half of the world's capital markets now, and those are significant commitments which are increasing over time. It's still, not a majority, that's for sure, but we're talking, 10 or 20% of global capital markets are now incorporating these issues, depending on how you count that. but it's growing very fast, and these things are not linear. And I think what we're seeing now is just large asset managers stepping up to deliver sustainable and impact investing strategies at a rate that we have never seen. And then we look at particular technologies like plant-based meat. I mean, I think we can't deny the volumes of capital going into plant-based meat to the at the rate now. It's coming off a low base, but look at plant-based milk. People take that for granted.
Let's get a perspective from Nikki on this now. And Nikki, you spent a lot of your career in the finance industry. Tell me whether you think the people, your former colleagues, are really coming around to this new frame of mind. I mean, I remember a couple of years ago when BlackRock first issued its statement to investors about how we really should be taking this stuff more seriously, and everyone was a little bit shocked and a little bit amused, and I'm not sure anyone really did anything about it. How do you feel about it?
Yeah, thanks, Timo. It's a very, very interesting question, because I have a foot in both camps there between the two perspectives that have just been voiced. And one is, it wasn't so long ago, probably 5 years ago, that talking about sustainable finance in this market in Southeast Asia, no one really understood what it was. So that has really changed. I mean, it's now a hot topic. It's something that every financial institution either has capability that they're existing now, or that they're building, or both, and measuring how much of their capital is going into various sustainable or SDGs or sustainable areas. So climate, of course, is a very, very big one. What I think still needs to happen, and this was really interesting to read just this week, Mark Carney coming out and talking about the risk of the finance sector creating another subprime bubble with sustainability, or with carbon in particular. And let's just keep it real. So let's not create all of these really fancy financial instruments that nobody actually really understands. And I think people do understand what is on the table at the moment. But let's not create layers and layers of financial instruments that nobody understands, and then find that we've not actually achieved a reduction in emissions.
Look, I think that the hazard of the financial industry doing what it did during the subprime crisis is a really important point to make, and I want to get into that in some depth, actually. But before we do that, let's just consider the broad picture and move into a situation where, all right, let's accept then that this position that the finance industry is beginning to move wholesale into a new frame of mind and into a new frame of strategic activity that does take into account the necessities of the Sustainable Development Goals. Let's be optimistic about the idea. So if we accept that as a general premise, let's then talk about what they can do to make a difference. Nikki, what do you think are specific activities that the financial professionals should now be thinking? What's their top line first step that they should be thinking in terms of in order to transform their business?
Yeah, the most important one is to set some targets or create awareness and set some targets. And a lot of financial institutions are doing that. I think in this part of the world, it's a little bit slower. And I think that is a function of just really raising awareness and putting climate and emissions up there in importance with economic development. So when you see the various countries in this region establishing their COVID recovery plans, and indeed the ASEAN Comprehensive Recovery Framework, which has some very specific actions, particularly for the finance sector to take, then how important and how specific are the actions that are being taken in there? And really, what was great to see in that regional recovery plan was the sustainability featured highly, and climate and emissions were important. What was perhaps something that could have been a bigger step forward was to integrate that through every element of the recovery framework, as opposed to having it as a separate issue. And I think that is the essence of what the next step for financial institutions is to integrate elements of sustainability, climate, social, governance into every aspect of their business, as opposed to either a risk check. Are we in compliance with policy procedure and let's tick the box, or can we report it? Is there something being a bit harsh here perhaps, but is it something that you can just report on that sounds good? So how do you make sure that every individual in the financial system, in the financial organisation, has a clear understanding of the risks and the opportunities, and a clear understanding of how their role can either be additive or detract?
James, you had you've obviously been involved with these kind of questions for a long time, and your involvement with the PRI, the Principles for Responsible Investment. What are your thoughts on frameworks? Are there any that are adequate to the task for the global financial industry? And should we think of this question as a one-size-fits-all response for the financial professionals?
Yeah, look, we see it in a couple of different dimensions. The first one is it's important that investors decarbonize their portfolios. Now, the traditional, and I guess it's still very new, but carbon footprinting is now seen as the traditional approach, because it doesn't get to whether companies are actually well equipped for a low carbon future. So many investors are now doing carbon footprinting of their portfolios and trying to reduce that footprint. Now, this is a really can be an ineffective way of dealing with climate risk. For example, there are
you wrote an article in Bloomberg very recently in which, and I've written down the quote because I thought it summed it up: decarbonizing your portfolio isn't the same as building a portfolio that helps to decarbonize the world. Explain what the difference is.
Yeah, exactly. So there are actually two different points here. The first one is that you can decarbonize your portfolio simply by reducing exposure to high emitting companies. But some of those high emitting companies may be building wind turbines. So that doesn't make any sense. Other low emitting companies may be a media company supporting a fossil fuel region, and that doesn't make any sense either. So simply looking at decarbonizing of a portfolio from a carbon footprinting perspective is a very, very broad brush, and the finance sector needs to dig into business models and exposure of every single company and the sector and the region, and try to understand from a fundamental perspective, is this company carbon transition ready? So that's the first point. The second point, which was based, that quote was based around, was the idea that you can, even in a sophisticated way, reduce your own exposure to carbon as an investor by investing in companies that are very well prepared for a low carbon future and divesting from companies that are not prepared. That still doesn't necessarily help to drive a low carbon future if all you're doing is trading shares in a liquid market, a secondary market, because you're not driving capital into the solutions that are going to help us get to a low carbon future. So what the point we made in our white paper, the decarbonizing portfolio, is that investors need to proactively allocate capital into solutions companies at their earlier stages. Add that, additionality of capital is the concept we use.
Right.
And actually fund venture capital, private equity, green unlisted real estate, renewable energy infrastructure in private markets. And then in public markets, it's all about shareholder engagement. And that is using shareholder power to encourage companies to address climate change and ensure that they are aligned with a low carbon future using your power as investors. Simply buying and selling stocks and bonds in a highly liquid market will not move the needle.
Paul, in your position where you're looking to invest money into companies, tell me what your response is in a practical sense to the thesis James has just laid out. I mean, how do you employ this kind of thinking in your actual activity?
No, that's a fantastic question. I think the thing to keep in mind is that larger asset management companies and larger private market investors probably have far more experience and track record in investing sustainably in ESG compliant companies, and particularly climate specific companies than very early stage venture capital firms. This is a realm of knowledge and expertise and understanding that is now starting to filter down into the earliest stages of investing, particularly in Asia. So, it's still very much of a new frontier. So even if I look at the handful of venture capital firms that are at the forefront of sustainable investing in Asia, it's still just a small handful, particularly the ones that aren't climate specific or impact funds, sort of the traditional venture capital firms. We are now starting to enter what has up until now been unknown territory for us. So a lot of it is, us as investors, educating ourselves, getting up to speed, understanding, the implications of sustainability and decarbonization, learning the science, learning the technology. That's on the investor side. But then also we're working with, entrepreneurs at the earliest stages, many of them first-time entrepreneurs. Who have a double challenge. One, how do they actually build a scalable business, regardless of the industry? But then also working hand in hand with these entrepreneurs to understand that, we want to build ESG compliant organizations. We want them to start thinking about sustainability. We want them to start factoring in how do they manage towards climate related or impact related metrics. How
does that go down, Paul? I mean, how do you have that conversation? I would imagine that most startup businesses and the businesses at the stage of investment that you're looking at, they don't go into business with these thoughts at the forefront of their mind, and then they get a financier coming to them and saying, well, you need to build this stuff into your business model. How does that conversation go?
Oh, I mean, you're absolutely right. If you have three founders who are maybe 3 months away from running out of cash, and they're just worried about surviving, they have a hard enough time building, GAAP compliant, financial statements, much less thinking about an entire, carbon friendly structure. Or environmentally friendly structure. So it's one of those areas where, as an investor, you say, you need to be ESG compliant. A lot of them do see that as a bit of an additional burden, but you do get a number of companies where entrepreneurs are incredibly values driven themselves. A lot of them are motivated, particularly the ones that are in the sustainability space. That's an easier sell. But I think there's this growing realization that an increasing amount of the world's capital are being directed towards ESG compliant, sustainably minded organizations. So over time, it's something that is eventually going to happen in their cycle, lest they get shut out of capital markets.
So that awareness is key, and Nikki, you brought that up earlier on. So how do we then begin to get everybody on the same page? The World Economic Forum is taking this very seriously. A lot of what you're doing now is trying to create that ecosystem of understanding and awareness and action. When you began considering this through the WEF lens, and when WEF began considering this, and I know they've done a lot of work and from multiple different angles, but just give me your sense of how this proceeds from here. How does one begin to build that consensus?
Yeah, not simply. So to Paul's point, there's some complexities here that are not necessarily accessible to everybody. Who they are accessible to, though, are definitely the larger, more mature financial institutions who can definitely take a leadership role. What we are trying to do across not just the SDEP platform, which is funding capital flows into SDGs, or helping to create, we're not funding ourselves, but creating the conditions for those flows to happen, is working with the other platforms across the forum that are specialised in particular sectors, so energy, agriculture and natural capital, and other major sectors that can shift the dial on emissions and somehow get us faster and in a larger scale towards net zero, or at least to our 2-degree targets in less than 10 years. And so it's really a multi-stakeholder approach, Timur. The solution isn't in the hands of one sector or one type of institution, and so this is where the forums and what attracted me to go and work in this is the power of the forum to convene those multi-stakeholder conversations, and then move those conversations swiftly from conversation to action. What does action look like? And to give you an example, we're working at the moment with some stakeholders around energy transition, because quite frankly, if you don't shift the dial on energy, we've lost the game's over. Like, it has to. It's such an important sector, not just for energy itself and energy generation itself, but actually the energy that's required in all the other industries, and so decarbonising all other industries, so it has such a far-reaching impact. And so what we're looking at is, what are the transformational, scalable solutions in financing that can really move the needle on getting the capital into either technologically innovative solutions, or importantly renewables and away from fossil fuels. The problem that we have that we're trying to solve is you can't immediately leave fossil fuels in this region, because they make up in the realms of 40 to 60%, depending on the country, of energy generation. And so just saying, okay, we're just not going to fund them is naive and difficult for countries in this region.
We're talking about mindset, and we need to get them to a point where they recognize that it's an incredibly important thing for them to do, rather than carry on business as usual. But we don't want to sort of get too deeply into that conceptual territory. Let me take the conversation back to the point that you made earlier, and that is the idea of bad actors in the process. Because so far we've been talking a lot in terms of everybody's coming to this conversation with good faith. And I'm sorry for all of you folks in the financial world, but unfortunately the financial world has proven time and again that a lot of the actors in that barrel are bad apples, and they don't act in good faith. There was an interesting article only this week, I think it was this week, from Simon Lewis, who's a professor of global change at the University College London. And I just want to quote to you what he said in this article. And James, I'll put this to you and ask you to respond to this. He said, net zero increasingly involves highly questionable carbon accounting. As a result, the new politics swirling around net zero targets is rapidly becoming a confusing and dangerous mix of pragmatism, self-delusion, and weapons-grade greenwash. And he went on to talk about how, as Nikki pointed out earlier on, all this points us down a path where financialization of some of these carbon tools that we've been talking about leads to a similar subprime situation. Do you see this as being a real danger? And if so, how can we address it?
Look, I think the most important thing is to get capital into the new technologies and early stage companies, so that, again, like what I mentioned before, countries like Indonesia and India simply won't want to burn coal anymore. So I think there is a role, particularly in developed countries, for commitments around net zero and for large corporations to see which ways they can transform their business models to be aligned with a low carbon future. But at the end of the day, we need to develop those new technologies so that we have better solutions that are cheaper. And I think getting capital deployed into the early stage technologies, whether it be carbon neutral cement, whether it be the new generation of nuclear fusion, nuclear fission, what Bill Gates is investing in, they're even transforming the grid and optimizing the grid is tremendously impactful for energy reduction. We're seeing long duration batteries, which can allow wind farms and solar farms to become baseload. These technologies are really looking realistic in the next 10 years. And I think, yes, we can, gnash our teeth around a whole range of are the metrics and the net zero commitments sufficient? But I think at the end of the day, what will solve this will be finding better ways to produce energy in much cleaner ways.
You're looking from an investor perspective and making sure that the money that is invested goes to the right places, and that's perfectly valid. But I would say that what I'm talking about is not a gnashing of teeth. What I'm talking about is the difference between failure and success. Nikki, there are companies out there, major global corporations, who are predicating their entire claim to net zero on the basis of trading in legacy carbon credits, which are meaningless, who are trading off their existing emissions with a promise of planting forests in the future that will likely never arise. How do we address issues like that in terms of how we do these things? And how do we stop the financial markets from creating such credit products and things that give the appearance of being valuable and yet actually are just a cover?
I wish I knew the answer to that, Timor. I think it's a fantastic question that is really very, very difficult, because it goes to the heart of capitalism, making money over everything else, over and above everything else, is a difficult challenge in the context of climate, and because we don't have sufficient measures, universal measures, such as price on universal working carbon market, to be able to. As you've rightly pointed out, it's quite dysfunctional in some respects, the carbon market, and so without that, we can't bring those externalities into what we see as primacy, which is financial outcomes. And I think I actually really relate very much to what James and Paul are saying about keeping it real, right? So if we look at where capital is going, new capital, so additionality. So if we look at where new capital is going, and we say, look, these are the really important areas of both innovation, but also how do you make room for these innovations? So I know I'm circling back to a point that you tried to get me off earlier, but if you look at the reliance in this part of the world, and also other parts, other emerging markets, on fossil fuels in energy, the long tail of the assets means that it is going to be very difficult, and certainly not in any time soon, that the addiction to fossil fuel will be somehow, will be alleviated. And to James, I love your point around innovation and getting money into innovation. It takes time, and I'm not really sure that we've got a lot of it. So if we're looking at the solution, coming back to your question, Timor, I think it has to be both on an innovation perspective, but also on a how do you shift the landscape to make room for innovation? How do you make sure that the crowding, that the existing investments, the existing technologies, the old stuff, doesn't crowd out the new, or only allow it to be at the fringe. So, and that I think requires a number of large sources of capital, long-term patient sources of capital coming together and making sure that old fossil fuel or old carbon emitting sectors are retired earlier, soonest.
Paul, so give me a little bit of an Asian flavor to this. I mean, we've touched on the Asian context a bit, but tell me a little bit more about how you can make a difference if we have this developing market with lots of companies trying to make a difference, and then people like you who are actually putting real funds to work rather than simply trading existing financial instruments. What does the landscape look like for you in terms of being able to make a difference, and how quickly can we get others like you onto this mindset?
Well, I think developments in Asia are quite positive. I mean, I think to James's earlier point, even if the amount of tension and capital is at a fairly low percentage, the speed with which capital and ideas coming into the sustainability space, and particularly the climate space, is accelerating quite rapidly. I think there was already some attention to some of the issues around Asia. I think a few years ago, or I think it was just a year ago, that Thailand had their own sort of smog apocalypse. The air quality index just went through the roof. Everyone was wearing masks, I think, in the months leading up to COVID-19. So we were already dealing with, air quality issues. I think there was a very big recognition of how much the Southeast Asian economies were contributing to ocean plastic. I think there were issues that were sort of becoming top of mind even before the pandemic. And I think only since then, there's been an acceleration in ideas and passion and commitment to solving some of these issues. Because I think there's this growing recognition that, all of these environmental issues, whether it's, slash and burn, agriculture, leading to air quality, whether it's, a lot of the effluent and waste coming from our manufacturing industry, whether it's the food waste and the plastic waste coming from our highly consumeristic societies. I think the pandemic has only sort of accelerated thinking around that, and as a result, I'm starting to see, both within Gobi partners, but as well as a number of our brother and sister VC funds in the region, this growing recognition that there are opportunities. I think climate, it creates phenomenally large problems, but from the VC perspective, large problems also equal large opportunities. So I think in terms of dedication around solutions and capital, I'm quite positive for where Asia, and particularly Southeast Asia, are going over the next few years. All
right, folks. We've been talking about existing situations and the current conditions, and a little bit of trajectory movement. Let's extend our timeline a little bit into the future, and I want to ask each of you to think about what you think within the financial field, within the scope of the work in which you are involved. What are the more significant, the most important elements that need to be put into place as soon as possible, and what their long-term meaning will be if we can manage your desired outcomes? Tell me your fondest wish for the financial world, the financial industry, to make a difference to the carbon situation. James, let's begin with you.
Yeah, I think a lot of people don't recognize the power of investors as owners of existing assets and existing companies. And we're seeing a lot of momentum in the shareholder engagement space. Now, shareholder engagement is where listed equities shareholders use their power and influence to engage with companies and encourage those companies to be more sustainable, to transition to a lower carbon strategy. And we have initiatives like the Climate Action 100 Plus, which now has, I believe, tens of trillions of dollars in assets signed up and are voting and filing shareholder resolutions, really asking and demanding that companies take action to mitigate their greenhouse gas emissions. So we are now getting majority votes in a number of shareholder resolutions that are filed at company AGMs. And when a majority or even a large minority, even more than 20 or 25% of a company's shareholders express concern through the AGM process about a company's approach to carbon, it sends a very strong signal to the board and senior management of those companies. So I would like to see us as a finance sector really stepping that up so that many shareholder proposals asking companies to take action on climate change along the lines of what the Climate Action 100 Plus is doing. A lot more equity investors even take this seriously. So I think that will really move the needle.
Fantastic. Paul, over to you.
Well, I think probably vital to the early stage startup space and venture capital space is we probably need to start seeing some sort of thoughts coalescing around common metrics. I think probably one of the most challenging aspects of sustainable investment in general is how do you measure impact and how do you map that to financial returns, and this is not just carbon related. I think this is something that's sort of something that the entire responsible investment space is struggling with. But
do you think this is the entire global responsible investing space, or do you think it's a particular problem in Asia?
Well, I mean, I think it's impact measurement and tying that to financial returns, is an issue that impacts the entire impact space, and so it makes it difficult to direct capital to the technologies that would benefit from it if investors don't understand how to map these types of returns, greenhouse gas emissions, how do you map that to a financial return metric? That's something that most limited partners and venture capital investors struggle to understand. And it's rightfully so, because, impact measurement is still an area that is highly evolving. It's incredibly complex, but having these types of metrics and measurement allows all stakeholders to start speaking in a common language, because we're talking about I think to Nikki's point, this is an area that is going to require a lot of multi-stakeholder collaboration and engagement, and so there needs to be common frameworks, common metrics, common language. Otherwise, I think we're kind of operating in our own silos.
So, Nikki, what do you think is the most important thing that we need to be focusing on in order to make the financial industry a significant mover of the needle, if I can put it that way, in the decarbonization conversation?
There's some really fabulous examples out there of what I think is really essential. And one of those is a recent initiative that's been started, which is called Fast Infra. And the organisation
is that an acronym?
No, Fast Infra. Infrastructure. Infrastructure.
Yeah, but its name's odd because it actually I think the idea is that it's going to accelerate the investment into sustainable infrastructure. Is the reason for the name, but it sort of doesn't necessarily have sustainability in it, and I think that might actually be intentional. But in order to make it feel more mainstream and less sort of special or something new or difficult, to Paul's point, these multi-stakeholder partnerships are essential. So Fast Infra, for example, is a public-private sector initiative. It has multiple financial institutions as well as multilaterals that are working together to try and set up almost like a funding club to say, these are the terms that we can push capital at scale into sustainable infrastructure. It's just one example, and I think we need more of this. I think the more that we can have public sector, private sector even philanthropic and family money going into collective action, then the faster this is going to move, and the better will be, because then we align in our objectives. We actually sit around the table and say, yes, we do all want this, and we're perhaps a little less inclined to not be answerable.
Okay, so and just a quick final corollary to that question. I wonder whether the Asian perspective, the conditions in Asia, merit a particular twist or a particular added effort in this context. James, I mean, this region is incredibly diverse, not only from its levels of development and the way that the economies are constructed, but every other part of how things work. And yet, as we said at the beginning, it's the critical component in changing anything, because if we don't start to nudge Asia more towards a carbonless trajectory, we're all doomed. So can you just give me an element of how you see the Asian element of this fitting into the broader conversation? You're sitting there in Switzerland and having these global dialogues. Tell me what you think of the Asian context.
Yeah, I think if we look at solar PV, I think we can credit China for creating a huge amount of the cost reduction through their scaling up of solar PV manufacturing. And I think Asia will do the same for other technologies, whether they are electric vehicles, battery technologies, other clean technologies that are coming online soon. So I think in terms of manufacturing, Asia is very well placed to actually benefit tremendously economically from these massive cost reductions, which are inevitable in clean energy and other clean technologies. So I would see it very much as an opportunity. And as those cost curves come down, the consumption side will just make more sense to transition into these cleaner technologies.
It's an interesting scenario, isn't it? Asia as a sort of a proving ground for the new technologies and a leapfrogging market, if you like, to bring them into operation much sooner than they might otherwise in a legacy industry. I kind of like that. Paul, how about you? Tell me about your thoughts on the Asian context. I mean, you've already given us some, but as a final summary.
Yeah, no, well, I mean, I think one thing to keep in mind is as we start thinking about decarbonization is not just looking at the energy industry itself, but all the different industries that contribute to carbon emissions. So, the manufacturing industry, the agricultural and food industry, tourism and travel. These are all industries that drive the GDPs of many of the countries in Southeast Asia. So, I think we were talking either earlier or offline about some of these technologies around alternative protein and plant-based meat, and how that would basically reduce resource inputs. It would have less impact on land usage, and that actually reduces carbon output quite tremendously. You look at industries like apparel and fashion, and where much of the world's clothes is made in South Asia. Being able to find ways to green those processes and reduce the amount of waste would ultimately reduce the burden on decarbonization. So, there are a wide variety of industries and technologies that come into play, and as a result, create a lot of rich investment opportunities.
And then I'll leave the final word then to Nikki. Give us your final thoughts on the Asian context and decarbonization from a financial perspective.
Yeah, this region has such an enormous opportunity, and it has some really motivated and smart people here who are working on this as a priority. And I think one of the interesting aspects of this region around carbon is many of the countries collectively form a natural carbon sink, and it's being talked about. No one's quite nailed yet how to make that work from an an economic and emissions reduction perspective. But there's a lot of minds that are coalescing around that to try and really use that physical asset that Asia has. But I just want to connect something also to Paul's point around the different sectors. You know, just in the last week or so, you know, a country who, you know, is quite far down in the development scale compared to others in this region, being Cambodia, has committed enhanced NDCs by merely bringing two sectors, agriculture and waste, into their NDCs that weren't there before, and they've said, okay, we're now going to tackle this and make this part of our pledge. Now, the other countries are, you know, working on theirs as well, but there's some really specific action being taken, and it's not just energy. I agree, although energy is important, and we will see COVID recovery being an opportunity for this region to be able to really define a new way, an more environmentally positive and socially positive way to run this regional economy.
Fantastic. Folks, it's been a pleasure talking to all of you. Thank you so much for your input and your comments. One thing that we haven't talked about is the public sector financial system and how that fits into the conversation. And the next in this series of Carbonless Asia Leadership Conversations is going to talk about the policy environment around the carbon issue in Asia, not from a specifically financial perspective, but what I'm hoping is that all three of you will join us for the Carbonless Forum on March the 31st, where we're hoping to bring together some of these threads and we can start really solidifying some of the ideas that we've had and the conversation and the framework around having these conversations into something a bit more meaningful that can outlast these brief interactions that we've been having on this, and we can turn into an ongoing community. So I really hope that all of you can join us on March the 31st and really take the next step into trying to sketch out that framework of dialogue and action for this thing and be part of our Carbonless community. But for the moment, I appreciate you joining me today. Really enjoyed talking to you and look forward to seeing you again. And to the audience watching, thank you for being there. That's it from this program. Join us again for the next one, which is the policy lens on Carbonless Asia. See you next time.